Hello everybody, welcome to On the Edge with Enza. Today I'm going to talk about ADP employment report, about Fed's interest rate cuts that are expected to happen this month of September, as well about jobless claims and how that influences the financial landscape currently. The financial landscape was a mixed bag, with Nasdaq only inching up 25 basis points on Friday. The ADP employment report, a precursor to the government's labor statistics, indicated a tepid addition of 99,000 private payroll jobs, falling short of the estimate of 140,000 anticipated by market analysts. The underperformance led to a dip in pre-market session on Friday, although there was a brief recovery at the market's open. However, at the close of the trading day, the majority of the stocks had surrendered to losses. Market sentiment on Friday, and I would say the whole last week, was very jittery, reflecting concerns about a weakening job market. The big question on investors' mind is whether this will result a soft landing that Federal Reserve has been aiming for, or the situation will decline more rapidly and severely than expected. The Challenger job cut report did little to reduce these fears, showing increase in job cuts compared to the previous month. The weekly jobless claims offered positive news, coming in slightly below the expectations. The PMI composite and ISM services index reports provided a more nuanced view, with both indices showing slight improvements and beating estimates, suggesting that there is a resilience in service sector. Despite this, the overall focus remains on labor market, especially with the upcoming CPI that is expected to be announced this week on Wednesday. So this CPI report will be critical in shaping Fed's policy decision in coming months, particularly with regards to interest rate cuts. The Labor Department's report compounded the gloomy outlook, with a significant drop in Dow Jones Industrial Average and Nasdaq Composite entering correction territory, largely due to disappointing tech earnings. And this has reignited concerns about economic downturn, with banking and small companies and tech sector experiencing notable declines. The report has also led to a decrease in treasury yields, further signaling investors' sentiment in the face of potential economic headwinds. Financial markets are now poised for the next set of data that are coming this week, which will influence undoubtedly Fed's decision as we head into the final quarter of the year. The Challenger job cut report showed a significant increase in job cuts to 75,891 from the previous month's 25,885. However, there was a slight improvement in weekly jobless claims, which fell by 5,000 to 227,000, slightly better than expected 230,000. The PMI composite report provided a mixed view, with the composite index rising to 54.6 from the previous month 54.3, and surpassing the estimates of 54.1. The service index also saw an increase, coming at 55.7 compared to the previous month's 55, and it was expected to report 55.2. ISM services index showed a marginal increase of 51.5 versus previous month 51.4, and the estimate was 51.1. With Friday's employment report released, market's attention is now shifting for this week's CPI and PPI inflation reports. Although inflation fears have diminished, the increased risk to the labor market is now in the spotlight. It seems unlikely that the Fed will not cut interest rates in the upcoming 2 weeks, but forthcoming reports will influence the Fed's decision in November as well December. Adding to the concerns of economic slowdown, the Labor Department's report sends stocks in a downward spiral. The Dow Jones Industrial Average plummeted to over 600 points, and the Nasdaq Composite entered into correction territory, affected by disappointing earnings from major tech companies, the hiring slowdown, and that reignited the fears of economic downturn, impacting bank stocks, small companies, tech firms significantly. So the financial landscape remains uncertain for now, with treasury yields also experiencing decline. Investors and analysts are closely monitoring these developments, as this could have far-reaching implications for the economy and for the markets. So the coming weeks will be crucial in determining the trajectory of the U.S. economy and Federal Reserve's response to all these challenges. The labor market's struggles are not solitary indicators of distress. Additional data, including a decline in manufacturing employment reported by the Institute for Supply Management, and disappointing earnings reports from tech giants like Intel, have also contributed to prevailing pessimistic sentiment. The oil market now, when it comes to oil market, it has been on a roller coaster in the recent months, despite several factors that should have ideally bolstered the market. Oil prices have experienced a significant drop. So West Texas Instrument crude, which stood at approximately $85 per barrel just 6 months ago, has now fallen below $70 per barrel, and this downturn is attributed to a myriad of reasons, including deterioration in the demand from major regions like China, Europe, North America, which has raised even concerns about global economic slowdown, particularly impacting the oil sector. China's role as a leading oil importer means that any reduction in its demand is likely to have profound effect on the energy market. Moreover, there is an anticipation in the markets for potential production increases from OPEC Plus in October. It's important to remember that OPEC has been curtailing the oil production to counterbalance the diminished demand and the general economic slowdown across the globe. The benchmark S&P 500 on Friday plunged to its worst weekly performance since early March 2023. And this is driven by concerns over economic growth after a slew of soft data during the last week, as well because of the labor market, and this was coupled with historical September weakness that led to a gloomy atmosphere and heavy selling on the market. The hotly anticipated August job report was supposed to swing markets' expectation one way or the other on the size of the expected Federal Reserve interest rate cut later this month. But now it ended up sparking a debate instead. The attention now turns to this week's consumer inflation report for further clues. S&P slumped 4.3%, while Nasdaq Composite created down 5.8%. The Dow Jones slipped to 2.9% last week. U.S. Treasury yields fell across the board, and growth concerns and softer than expected July job report opening print lifted bets of 50 basis points interest rate cuts by Fed this month. As well, the mixed non-farm payroll report, the yield curve between 10-year Treasury yield and 2-year Treasury yield briefly normalized for the second time in over 2 years. After uninverting last month for the first time on 25 consecutive months. An inverted yield is widely seen as a recession indicator, but normalization of the curve is not necessarily a positive sign, as the curve can uninvert before a recession hits. The current financial landscape is marked by volatility and uncertainty, with key indicators reflecting investors' apprehension and cautious outlook towards markets. The Federal Reserve's next step, the labor market's trajectory, and the oil industry fluctuations remain critical factors to watch how the global economy navigates through these challenging times. Last week, U.S. crude oil inventories saw a drop down of 6.9 million barrels. This is a staggering amount for a week and far exceeding analyst expectations. And the drawdown has pushed inventories 5% below the 5-year average for the first time this year. So oil demand remains robust despite economic headwinds. Historical data from Statista shows that significant drops in oil demands are rare. The only significant drop between 2005 and 2023 was during COVID time, and bearing another black swan event that triggers an economic slowdown. Oil demand isn't about to fall off a cliff anytime soon. Energy demand is projected to skyrocket thanks to the emergence of artificial intelligence and other cutting-edge technologies. In recent history, energy demand has remained flat year over year, but It is projected to grow 2 to 3% annually in the foreseeable future. Oil market is very cyclical, so while the current pullback has caught many off guard, history suggests that oil sector will bounce back. Thank you for watching me today. I hope you enjoyed my opinion of current financial landscape. Bye. Thank you.